Let's talk merger models, more specifically, merger math, accretion dilution stuff, everything you're going to need for your investment banking interviews. I'm going to do this a little bit differently than I've done the paper LBOs in the past. The main difference here is that I went ahead and I fleshed out a merger model from scratch ahead of time that we can walk through. Why did I do that? The main reason is that if I were to pull up a real deal-ready merger model, it would just be too overwhelming. There's too much stuff that you don't need to understand for your interviews that you can learn later, and you just don't have enough time, and it's not a good place for a beginner to start. So what I did is I built a very simple merger model to answer basic to relatively advanced merger questions, things that you can be asked in an interview realistically. Another thing that I thought would be helpful, it's a pretty typical practice for like Pillars of Wall Street and Training the Street. All the math you can see is done in this column F. That's where like all the calculations are, the answers and everything. In column H, I put all the formulas. So you can see like if I F2 it to audit it, you can see that that corresponds to column H. So this should help you follow along at home. It's all right. Okay, so you can see like down to my actual accretion dilution calculations, which I'll get to in a minute. But right, it all corresponds there. So even if I'm not F2ing things, hopefully you can follow along well. I'm sure a lot of people are going to ask if I can send them this file since I obviously like built it. It's a bit difficult to send an Excel file to thousands, tens of thousands of people. But I did, if you see in my profile, we just made a new Project Wall Street Instagram account, and we're doing this thing where like the first 1,000 followers, just to incentivize people to follow, is free, obviously, not taking your money. We're going to give you like access to like a live session that otherwise might just be for like Project Wall Street fellows. So maybe I can think about how to like distribute something like this to a select group as well. And like the big formulas that you see here, don't worry about it. I'm just a loser. I'm going to be using this model probably going forward for simple training and stuff. So I figured I would kind of get it to my standards, All right, let's get started. Acquire Co., you guessed it, they're the company that's going to acquire another company, has net income of $200, share price of $6, 10 shares outstanding. Target Co., obviously the company that Acquire Co. is going to buy, has net income of $200, share price of $5, 6 shares outstanding. If Acquire Co. were to purchase Target Co. in an all-stock deal at a 20% purchase price premium, what is the percentage change in accretion dilution? All right, let's get through this. First, as with any model, just go ahead and put down your assumptions so that you can link and use Excel properly. The blues are hard codes, obviously. Anything here, these are just inputs, so they're not formulas. But what we can do is calculate our earnings per share for Acquire Co. and Target Co. Why do we calculate earnings per share? Because when we're talking about accretion dilution, what we're talking about is the impact that an acquisition has on the parent company or the go-forward pro forma entity. If the earnings per share of the pro forma entity increased from the standalone entity, so like earnings per share has gotten bigger after the acquisition, that is accretive. If it's gone down, that's dilutive. Earnings per share, you want more earnings per share. And how do we calculate earnings per share with what they gave us? Super easy. You just take net income divided by shares outstanding. So very easy with very little work, we were able to figure out our earnings per share for our standalone Acquire Co. before acquisition. Next is to model out the actual acquisition of Target Co. So again, Acquire Co. is acquiring Target Co. This is an all stock deal, right? So we're just talking like stocks. So we're talking market cap and purchase price. Market cap is a proxy for equity value, and purchase price is basically a proxy for enterprise value. But there's no debt, so you don't need to overthink it. What do you do to get market cap? Most people probably know this. You take Target Co. share price times their shares outstanding. That's their market cap. Super easy. Next step, they said there's a purchase premium. There's a couple ways to do this. It's super easy algebra. The way I did it, I just took it's 20%. So we know that you're going to get an additional 20% on the 30. So you can make it an addition. Alternatively, you could do 30 times 1 plus 20%, and that'd be the same thing. But purchase price is 36 because it's a 20% premium on market value. Next, we need to get our pro forma or post-acquisition shares outstanding and earnings per share, fully diluted as well, although we don't have warrants or anything in this case. First step, let's just get our shares outstanding. So we know we bought the company for $36, currently trading at $6 per share. Why do we use Acquire Co? Because we bought Target Co. They merged into us. So now they're part of us. So our implied new shares outstanding, you just take the value of Target Co divided by Acquire Co share price. So that's going to be an implied 6 more shares outstanding. We already had 10. That was just given to us with Acquire Co. What that means is that we now have 16. That shouldn't be money. We now have We now have 16 total shares outstanding in our pro forma entity. Now we can calculate our pro forma or post-acquisition merged entity earnings per share. That's what this is all about. First step, because it's pro forma and we merge the entities, add together both of the net incomes, Acquire Co and Target Co. We bought Target Co, so we get that $200 of net income, which was, again, just given to us. I didn't do anything. So it's $400, super easy. You just add whatever they were before the merger. How do we calculate earnings per share? Again, for a pro forma entity, now we have pro forma combined net income. We have pro forma combined shares outstanding. So it's the same formula, net income divided by shares outstanding. And that is going to lead us to having a total pro forma combined earnings per share of $25. What did we have prior as a standalone entity before the merger? $20. Guess what? This was accretive. Our earnings per share went up by $5. It went from $20 to $25. That's a good thing. And the question asks us specifically on a percentage basis, how accretive is it? It's 25% accretive. I'll F2 this. We can talk through it real quick, and then I think we're really good. So we started with $20 of earnings per share. We're now at 25, which means we went up by $5. 5 divided by 20 is 25%. It's a 25% increase on 20 to get to 25. Super basic algebra.